Good afternoon, Daniel. Thank you for joining us here today. I'm really excited to have you in the group talking about your specialty and your expertise. And guys, for those of you that don't know Daniel, he's our business and property finance specialist, and he's here today to really answer a few questions that are hopefully for you guys are really valuable and help you out a lot. So, Daniel, over to you. Do you want to give a brief introduction of yourself and what your business does?
Yeah, awesome. Thank you, Stuart, and thank you to everyone who's watching and checking this out. To give you a bit of an introduction, I am Daniel from Level Up Loans. We primarily focus on residential property investment and working with business owners to obtain finance. So one of the specialties of our brokerage is that we have an in-house ex-accountant that will analyze all the financials, and we primarily work with business owners. So that's one of our core focuses here at Level Up Loans. We know that getting finance as a business owner can be tricky. I'm sure you've got plenty of questions and you probably might not have found the experience to be fun in the past, but we're hoping to change that. So yeah, thank you, Stuart. And I'm looking forward to giving you guys some information today that might help you at least obtain finance or maybe make the process a bit simpler and easier.
100%. And as you were talking about that, I was thinking about how many people in the group will hear that first part about business owners struggling to get finance and you can help them. They're probably going to be like, I need to speak to this guy because everyone's gone through that where they think, I'll just go and get a loan for, whether it's personal or business. And it seems easy. And then you go through the process and it's not as easy as you think. So I'm
Yeah,
sure everyone's going to take a lot from today.
yeah, fantastic. Well, I'm sure they will, and hopefully I can give you as much information and then you can let me know if you've got any more questions.
Absolutely. So first question, Daniel, what's the most common financing mistakes business owners and investors make and how can they avoid them?
Well, mate, juicy one to start. I think as property investors and business owners in general, one of the key things that I see is that a lot of people focus heavily on what we would say is tax minimization. So as a business owner, you chat to your accountant and they're always telling you this is the way that we can minimize tax and reduce your income as much as possible. It just doesn't kind of work hand in hand when you're looking to obtain funding, though. Like it's very difficult to have a wealth accumulation strategy with a tax minimization strategy at the same time running together. So I would say probably one of the biggest mistakes that we see is just not pre-planning enough, not having a conversation early enough with a banker, a broker, someone like myself that can help you kind of basically step out what you need to do in order to get the finance in the future. Often we'll catch up with the accountant. We'll do the tax planning session with them. We'll go through it with you. We'll get a good understanding of your financials and we can kind of forecast what the figures need to look like in the future when you do go to get that loan. So you're in a good position because we might say to you, look, minimize tax this year, but then next year really try and focus on pushing those profits up because that's going to get you in the position that you need to unlock the lending that you're really looking for. So I think that's probably one of the biggest mistakes that we see, Stuart. It would be really around that tax minimization because at the end of the day, you need a lot of income on paper to borrow money in today's day and age, particularly with rates starting from 6% upwards at this stage.
That's a great point. And as you were talking, I was thinking about the conversations I've had with a lot of business owners, and I think the assumption in many accountants' minds is that everyone wants to minimize tax. And while that's important, to your point, it really depends on what stage of the cycle your business is in, and if you want to grow, tax minimization may be not the top priority if you're trying to invest back into the business, and that includes getting finance.
Yeah, 100%. Yeah, it'll often kind of be the hurdle that you need to try and balance and try and get over. It's a fine line between minimizing tax and having enough income to be able to do what you want to do. That's for sure.
Absolutely. How can business owners use asset finance to grow without tying up cash flow?
Yeah, this one is an interesting one. So often we're asked, should we go and buy vehicles and equipment utilizing cash, or should we go and get lending for it? There's kind of two different ways that you can view it. I would say from a lending perspective, a lot of the debt that you accumulate when you're purchasing assets is possibly tax deductible. I'm sure your accountant will be able to guide you on that. But it is much easier to get debt when you are purchasing an asset. So when you are doing secured lending, so that's where they secure a portion of finance against the vehicle itself or maybe over the piece of equipment, it's much easier to obtain finance. The rates are generally lower. And that means that you've then left cash available to preserve it as working capital for your business. It's much easier to utilize the cash to pay wages or things that pop up in your business in comparison to maybe utilizing that cash initially to go and buy the vehicles and equipment. And then later on, you need some additional funds and you try and borrow that from a bank. It's very costly and very hard to get because often you're going to the bank and you're saying, hey, I need more liquidity. Can you now lend me more money so that I can keep my business running? And it doesn't look very good. So getting the lending up front can be beneficial, and it is much easier to exclude some debts in businesses when you are trying to obtain future lending. Like, for instance, if you were to try and purchase a property, you may be able to exclude some business debt. Some banks will allow you to exclude the business debt associated with the vehicle and so forth. But if you've tied up all your capital in buying those assets and then you need liquidity to go and do your next investment venture, buy a business, buy a commercial property or buy a residential property, you might find it a bit harder.
Oh, and I've heard that for a number of experts in if you're waiting until you need finance to apply for finance, you're probably in the wrong position to actually get the finance. But a great
Exactly.
point. And I guess to add to that, to add some context, I think you can't foresee what's going to happen in your business, and having that cash flow as a priority whilst using finance is probably a great way to maintain some flexibility as a business owner.
Yeah, exactly. And most facilities now, if you're taking out debt against a vehicle or a piece of equipment, most lending facilities will have minimal exit fees, particularly on the secured lending on smaller amounts. Sometimes no break costs as well. So if you decide to take out the finance initially, but then maybe you're coming to a lot more capital from something else in your business and you go, hey, I've got too much cash now and I want to reduce some of these. Often you can pay them out with kind of little minimal exit fees on most of these loans. So at least you've got the option then.
That's a great point. Really great point. Well done. And do you find that borrowing capacity fluctuates between different lending options?
Massively. Yeah. This is really kind of the key benefit of having a broker, is that we really dive deep in terms of looking at what your options are when it comes to getting finance. For instance, just before this, I'm just chatting to a client who's looking to buy another property, and basically they'd been to a bank branch. They were told they could borrow about $200,000. With some basic restructuring that we did, we're able to unlock about another 800,000 worth of borrowing capacity just by making a few tweaks, moving some lending maybe to one bank to start off with one property, accessing equity out of that one, moving another loan across to a different lender, and then maybe going to a third tier lender for some additional lending to get this next property. So it is a big difference between banks, and it can vary, 100,000 to, $500 million in some instances. And it's really around the banking policy at the end of the day. Some banks have got good policies for certain things. Like, as an example, some banks might take 95% of rental income, where some banks will take 75% of rental income. Some banks will exclude your private school fees. So if your children are going to a private school and it's costing you $30,000 a year, some banks will actually exclude a portion of that and maybe put it in your general living expenses instead of an ongoing liability. So working with a broker and getting kind of the right fit based on your circumstances is going to enable you to borrow significantly more depending on what the circumstance is. And that also varies too around your credit profile. If your credit score is lower, some banks have a larger appetite for that. Some banks like credit scores that are really high, and then you've had limited inquiries, you might get a slightly sharper rate. So it definitely plays a big toll on what the differences is when it comes to borrowing money, that's for sure.
Yeah, absolutely. And those differences that you mentioned are huge. And I think it sounds like, to put an analogy, it's like a broker has the option to tailor finance to the owner's needs, as opposed to a banker that's in a bank that has to fit 5 products into the owner's needs. So it's a lot more restrictive.
Exactly. Yeah. If the triangle doesn't fit in the triangle slot, you're in trouble. And
Yeah,
they can only offer what they can offer. And they're usually not going to say to you, hey, walk, 6 shops down to the next bank branch, and they'd probably be able to do this for you. They're just going to tell you it
exactly.
can't be done. And often it's really sad, because as a business owner, you'll then walk away thinking that lending's not obtainable, or maybe that you've missed out on a really good investment opportunity. And sometimes it's hard as a broker to hear, because some people come to me going, hey, I could have brought this business, or I was going to go and buy this particular block of land, and it was a great offer at the time, but the bank said I couldn't get it. And I'm just looking at it going, oh, we could have made 2 simple changes here and you easily would have got the finance for this. And you're missing out on hundreds of thousands of dollars in some instances.
Yeah, absolutely. How can property investors use equity in their existing properties to fund new purchases?
Yep. Yeah, that's a good one. So in terms of drawing out equity, typically banks will allow you to borrow up to around 80% of your property's value. So as a general equation, you could say, do a calculation, say what's 80% of my property's value minus what do I owe, so your existing loan, and then that would give you what we call usable equity. So usable equity is the component, if your serviceability and your borrowing capacity allows, you can draw out that usable equity and you can go and put the funds towards your investment that you'd like to do. So, that's investing in things like shares, renovations, buying property. It's all about the purpose of the funds and what you end up doing with those. But typically, that is what most people are doing when they're drawing equity from an asset, that be it a property, commercial, residential, take that equity and then go and invest it in other opportunities elsewhere. You can push it up a little bit more if you needed to maybe borrow 90% against a property, but you have to pay a bit of lender's mortgage insurance and some risk fees in there. So kind of the sweet spot, if you can, is sticking around the 80% mark, drawing out that equity and then utilizing it to go and buy, let's say you go and buy another residential property that you're then going to rent out. So you can take those funds, you might split those funds up into two components. And let's say, for example, you might take 400,000 out of your equity and you go and put 200,000 each towards two separate investments. And that way, by drawing out the funds from your property, the funds then become tax deductible because the purpose of funds is for investment. You're then taking those funds and you're utilizing them to go and buy an investment property. Whereas if you were to take cash, let's just say you had 200,000 cash and you went and utilized those funds to go and buy the investment property, the 200,000 wouldn't be tax deductible. So it's not as beneficial to you. So often in our case, we would be helping people draw out the equity from their home to cover the 20% plus the costs on a future property purchase. And then that way it's fully tax deductible. They can claim all the benefits, even with the advice with the accountants, financial advisors as well. It's all claimable when you are relating it back to the investment property purchase.
That's some great advice, and I'm sure a lot of people had their ears prick up hearing that. It's like, oh, maybe I can not only get some tax savings, but get another property under my belt. So yeah.
Exactly. Yeah, it's a really good format. It's a great way to do it. And you can really split those funds up too. It's not so limiting to just, pulling out capital for one investment property. Often we're helping people pull capital out of multiple properties, sitting it there until the opportunity arises that they may want to kind of break up those funds and then go and purchase 1, 2, 3 properties at any one time. So it's something that you can definitely do.
Okay. And I'm wondering, do different lenders have different appetites around what you can use the funds for that pulling equity out of?
Yeah, definitely. So it all comes down to the purpose of the funds and then kind of ideally what banks want to see the funds used for. So as an example, if you were to take funds out of your equity to go and buy shares, often the bank would want to see that you have some capacity to be a share trader or have at least dealt in shares before. If you aren't able to demonstrate that, they might make you go and speak to a financial advisor and then get a letter of intent to say what the funds are going to be used for. So then you would come back, you would say, look, I've spoken to an advisor. He said I should pull out $200,000 and he will help me invest my money. And that way you can get around it. Often banks want to see if you're taking it from a residential property that you're utilizing the funds for something that is in the residential space is preferable, that be a commercial property as well, but you can utilize those funds. Banks typically don't like seeing you utilize your funds for business purposes. So
right.
I would be chatting to the accountant in regards to that and what you're calling out the purpose of funds and what you're planning to do with it. But ideally, banks want to see the funds drawn out to consolidate debts. That's very popular at this point in time, particularly in 2025. This is why we're so busy at the moment. Every time we tick over Christmas, people max out credit cards, take out all these lending facilities, and then for the first quarter of a year, we're basically consolidating debts for people. So, accessing some equity, paying out their car loans, paying out their credit cards, depending on what they want to do, just to free up some cash flow. It's a pretty common theme with most business owners at this point in time, and that can help them get back on track. And I would say in terms of utilizing the capital for something else, one of the most common one that is popping up recently, which some banks are now accommodating, is paying out ATO debts, because I think this will be pretty relevant to most business owners in this group. So what they're saying now is that if you have an ATO debt, and this was announced on the 16th of January, 2025, from the ATO, that if you have an ATO debt that exceeds $100,000, you don't have it on a payment plan, and there's a few other kind of bits to this, but if you don't have it on a payment plan, you haven't engaged the ATO to rectify and you're not paying it back, they will potentially list it on your credit profile. And this could limit your ability to get funding in the future. If you try and take out any other debt, the bank's going to identify it showing up on your credit profile, and they're not going to want to be able to, well, they're essentially not going to want to lend you the funds, right? Would you lend money to somebody that, potentially not paying their bills? It's a good way to identify that quite quickly.
So yeah, no, that's a great point. I think anyone out there that's listening that either has ATO debt or they're thinking about kind of sourcing some equity to kind of invest into other areas, it sounds like having a chat with yourself and their accountant at the same time would make a lot of sense.
Yep, exactly. And often there'll be a few parties involved, particularly if you're looking to invest in, property, or that be it commercial, residential. We usually suggest getting a few parties. We have a financial planner, we'd have the accountant involved, we might have a buyer's agent involved, and then ourselves. I think to achieve a lot of these goals in today's day and age, you really have to have a team that supports you and everyone's there to try and do their bit to be able to help you get it across the line because gone are the days of being a one-man band trying to buy multiple properties. You really need the advice piece, you need the structuring piece to be able to achieve your goals.
Absolutely, great advice. What's the biggest challenge business owners face when securing a loan, and how can they improve their chances?
Yeah, I'd say probably for a business owner, it's having the figures in a position where they're ready to be lent against. You've got your 2 years tax returns, or if you don't have your tax returns ready, what else do you have that you could possibly provide? So just being ready for whenever you go for the lending, that's probably one of the key things. And then minimizing inquiries and additional debt at the same time. So if you can try and minimize how many other credit inquiries you're putting through, ideally if you're going for a loan application, the goal is to get it approved the first time, not to go and try with every other lender. I think that's something I'm seeing more and more now is where
Mm,
people might go and apply online, they get a zip pay and afterpay, they go to Banjo, Judo, a lot of different banks. They're trying to get these lending facilities, shift and overdrafts, or you're trying to get the best points on your new credit card because you've been told to get a credit card for your business and you'll get all these nice Amex points and you can rack them up. But often people will go and inquire multiple times, and that's just bringing down your credit score. And it doesn't look good when you go to get lending when they go and see, oh, geez, you've applied for 10 different credit cards in the last 10 months. It just shows that
mm,
maybe you're in a position where something's happened that the bank doesn't know about. So they're going to start looking harder. And it also means that we've got to do a bit more digging as well. We've got to really help to bolster the case of when we're trying to apply for finance, why they should be giving it to you. Because at the end of the day, we're kind of the intermediary between you and the bank. So we're
mm.
trying to justify why we think you're a good fit and then why the bank should lend their money to you.
That's a great point. I think a couple of great points I would like to ask some clarifying questions. The first one is you mentioned 2 years financials, and if there's business people out there that are relatively new to business, they've only they haven't been trading for 2 years. Is there an option? And I guess the second question is related to like the afterpay or the short-term kind of payment plans. How does that impact the credit score? And I guess it's a bit of a loaded question. I think from memory, those impact a credit score more than like your general credit card and other types of loans. Is that right?
Yeah, it is. Like essentially, it's payday lending, right? It's you're drawing on those facilities. Although I know a lot of people don't utilize it for that method, a lot of people take out
Mm,
the facilities for convenience. And everywhere you look now, there's a button that says, "I'll just take this out." One of the most common ones now is the pay in four with PayPal. So every time you buy something on PayPal now, it'll pop up with an option that says, "Do you want to pay this in full?" As soon
mm,
as you press that button, it then does a credit inquiry. It shows up on your credit profile. So
right.
essentially, to the bank, it's looking like you don't have sufficient funds available to go and make that purchase. It then
Right.
shows that you need to be able to basically get payday lending to be able to borrow enough to be able to go and make the purchase that you're looking for. So it's not a good reflection of your ability to manage money for most lenders. So
Hmm.
if you can avoid it, it's good to steer clear of it. You can definitely close out those facilities, but they do show up often on the credit profile, which is then an inquiry, which is just unnecessary in most cases. I know a lot of people have got the funds for these, but it's just convenient, but
Yeah.
it can kind of impact your ability to borrow funds. And sometimes it gets out of hand. Maybe you go and take out 5 or 6 of these facilities, and then you might pay them out, but then it stays open because then we might go and do a
Mm.
lending application, and then sure enough, you're trying to get some money and then it pops up that you had this zip pay from 2 years ago and then you went to Harvey Norman and you brought a couch on interest free and now you've got a Latitude credit card and every time I ask you, have you got a Latitude credit card? You'll look at me and go, no. That's the common one. Everyone goes, no, I don't have a Latitude credit. I've never had it. I said, do you ever go to JB Hi-Fi or Harvey Norman and get something interest free? He says, I'm sure enough you do. So all those facilities will often stay open. You have to make a conscious effort to go and close them. So if you can avoid
Mm.
them, in short story, try and steer clear of them where possible. If the goal is to, potentially lend some money in the near future, because it
Right.
can have a bit of an impact on it.
Great, great. And is there any optimal period of time? So if someone's thinking about lending, how far out should they think about having those things off their record?
Yeah, I mean, ideally, we wouldn't see them in 3 months worth of bank statements. That's kind of
Okay.
the average amount that most banks will want to see and gather is 3 months worth of bank statements. As brokers, we will often collect 6 months. So if you can kind of get rid of them within that 6 to 3 month period, that is beneficial. And just a good reflection then that you're able to manage money and we can kind of see what that's tracking like. And then one of the other key things we just want to not see in the bank statements is, sports bet, gambling, adverse, payments, large sums of cash moving around. They're all things now that the banks have basically got a checklist for. So they're looking out for those items. If you can steer clear of it, definitely do so. And they've also wisened up now to, drawing large sums of cash out of ATMs. It is something that becomes more and more common that the banks are asking about. What are these withdrawals? Because sometimes people go, oh, I'll keep my living expenses down, or I'll make my expenses lower. I'll go and just pull the money out of an ATM and spend the cash. But then it becomes a regular theme. And then I have to answer the question when they come back to me and say, hey, what's Johnny and Mary doing pulling this $3,000 out every week from the ATM down the road? So, just try and steer clear of those things. It just has to make sense in general.
Nice. And it sounds like having a chat to someone like yourself early on, even before you're lending, to get prepared to when you go to borrow, sounds like a smart strategy. So you kind of can get all your ducks in a row.
Yeah, exactly. Yeah, that's what we would recommend. It's like, get in touch now. We'll review everything. It's not costing you anything for us to go through it in detail. We'll come back to you, at least let you know what your options are. I kind of pride myself on being a little bit black and white in terms of yay or nay. And I always try and give you an answer as to, if it doesn't work right now, what can you do? So at least you walk away knowing, look, I can go and make some changes and some actions that will get me in a position where I can proceed. We try not to be so vague, because I know a lot of lenders out there will kind of just tell you no, but then won't give you any steps to move forward. So, and we try and move quite quickly, because ideally we want to be able to give you a result as soon as possible so that you can make a decision whether it's something you need to focus on for now, or maybe it's a down the track, or maybe we just need to talk to the accountant and find a better solution and get him involved. And often we can try and structure something that's a good fit for you.
Nice. And the 2-year thing are there ways around not having operated for 2 years if you need finance, whether it's an asset or something else?
Yeah, exactly. There is ways around it. I'm pretty sure that'll be on our next point that we're going to cover off. But in terms of the ways around it and the options, so if you haven't been, let's say, for example, I've got a client at the moment that have only been operating for around 8 months. But from day one, they set up a company. And from that company, they then paid themselves wages. They are in a position to do so. And some banks' policies will allow us to utilize 6 months of directors' wages paid from a company. So if we have evidence via an income statement to show that they've been receiving wages, we can then utilize the income statement to go and borrow the funding. And the business doesn't need to be registered for 12 months, or it doesn't need 2 years worth of financials. So there's definitely some options out there. Again, though, it's kind of getting on the front foot, having the conversation to us early to say, what do you want to do? And then how can we help you get there? Because you might need to shut your account and say, look, the broker mentioned that this might be an option to help me obtain finance sooner, but based on the tax strategy and all the planning that you've got planned out for me, is this actually a good fit for me? Because at the end of the day, we don't know what your personal strategies and the background you've got with your account. We can just tell you what works and doesn't work with a bank. Some banks will accept 12 months tax returns. Some banks will accept notice of assessments. So you might be able to just print off your notice of assessment and give us a notice of assessment each, and we can utilize that for lending, which can be pretty beneficial because we might exclude all your business debts and any debt associated with your business. So there's definitely a few really good options out there. The most popular ones, though, are the director's wages, where you pay wages for 6 months, and then we can utilize the wages and we ignore everything else that the business has, holds, and does. So if you have a business that has a lot of debt in it, but you're in a position where you can pay yourself wages, we can then exclude the business itself and we just take the wage income. So that's really beneficial for a lot of people, but you have to be a company structure in order to do that. Ideally, you're GST registered, you're doing all those other bits and pieces.
Yeah, right. It's great to know that there's those options out there, because I'm sure people, like you said earlier, have probably gone to their bank and said, hey, I'd like to borrow for this. And they just said no, and they just assume they can't get finance.
Exactly. That's what I mean. It hurts me all the time because people come to me and they say, look, I had this opportunity. I could have brought a property. We could have got them into their 5th, 6th, 7th property 2.5 years ago, but they, went from working as a carpenter and then now they're a sole trader working for themselves as a subby, but they got told from someone they needed 2 years worth of financials. Like, we could have even utilized the pay from their employer in continuity with the subcontractor arrangement without even needing the ABN registered for 3 months. We could have gone, they're earning X amount with this employer, and then now they've gone and made a transition in the same field, doing the same stuff, but now they're a subcontractor. We could have actually just kept using their PAYG and a little bit of forecasting from the accountant to obtain the funding. We could have got it much sooner, so it's definitely worth having those conversations.
100%. I think if anything, if you take anything away from today's chat, guys, if you have been told no, you can't get finance, I'd recommend chatting to Daniel or another broker, whoever you feel more comfortable with, just to get that clarity. Because if you've gone to your bank, it might not necessarily be the done and dusted.
Yeah, and probably one of the most, I'd say, important and relevant to this group, because I know a lot of people in this group are really focusing on buying businesses, which is fantastic. One of the questions that I get asked quite a lot, and this is a bit of a trickier one. So if you were to buy a business and that business was to be trading for a period of time, let's say that business is trading for 3, 5, 10 years, it actually has a good historical history of financials. You've acquired the business and then you don't plan to work in it. You plan to maybe keep working your job or keep working your business, but you want to utilize the income from that business. Typically, the banks will want to see that you've had it at least 1 year's tax returns whilst owning that business, because they want to see once you've taken it over and the owner has exited, how have you been able to sustain and manage that income for a period of time? So 6 months with some accountants' forecasts is the bare minimum. So basically, you own the business and then you operate it for at least 6 months. Maybe you take some wages from that business, or maybe we go to the accountant and the accountant does some financial forecast for us to say, look, you've now been running it for 6 months. I anticipate this business is on track to do X amount, and they might support it with an accountant's letter. We can look to utilize those funds. So that can help to bolster your borrowing capacity utilizing the income from another business. But on average, the sweet spot is 1 year's financials whilst you own the business. So once you've taken it over, a year's gone by, you've got the full financials. That's a really good time to consider lending.
That's great to know. And just to clarify for everyone out there, is that the same for an asset purchase and a share purchase? Does that work the same for both?
Yeah.
Perfect. Awesome.
Yeah. Yeah,
great.
Typically the same for both. It does vary between some lenders, but I would say general rule of thumb, stick with that and you'll be looking pretty good.
Awesome. Sounds good. Sounds good. What are some creative ways property buyers can structure their loans to maximize borrowing capacity and financial flexibility?
Okay, so if your goal was to maybe maximize borrowing capacity, there's a few things that we would often work with our clients on. And bear in mind, there's obviously chat to your accountant and do all the rest. I'm not giving any of you financial advice, but if you wanted to maximize your borrowing capacity, some things and strategies people might consider is maybe putting their loan on interest only. If the loan's on interest only, it's lower mortgage repayments, the cash flow can be better. Some banks will actually take the interest only repayment instead of taking the P&I repayment. So let's just say, for argument's sake, the P&I repayment was $3,000 a month, but the interest only repayment was $2,500 a month. Some banks will actually take the $2,500 per month, the actual repayment whilst it's on interest only. And that can help to significantly increase your borrowing capacity. But often you're structuring this in pretty intricate ways, where I was saying previously, you might go to one bank for one portion of accessing equity out. You then may go to a different bank to then utilize the interest only facility they have. And then maybe you go to a third, fourth, fifth bank to be able to maximize that interest only terms and the way that the lenders assess it to be able to really try and extract out how much you can borrow. Pushing loan terms out to 30 years is a pretty common one. So pushing your loan term back out, although it means you're going to pay more interest over the life of the loan. So just bear that in mind. It can mean that you could potentially borrow some more funds because the debt's spread over a longer period of time. It means the repayments can be a bit lower, which can often mean you could borrow a little bit more in terms of lending. And then I would say probably the most interesting subject, and I would say most people have probably heard of this recently, is buying properties, that be it commercial, residential, in maybe a company or a trust structure. And this is where, as an example, you might go and purchase. If I was to go and buy a residential property, let's say I buy an apartment in Melbourne in the CBD, and I was to go and stick that in a trust with and hold the property in there. Once that property was able to demonstrate some positive yield and be able to cover its own liabilities. So once that property has enough income derived to be able to cover the debt associated with it and to break even, I could potentially then go back to my accountant and say, hey, could you please write me a letter to say that this particular property held in my trust can break even, can meet its own ongoing liabilities, and it can service itself. And then some banks would allow us to exclude that debt like it never existed. Because I'm not using the rental income and it can cover itself, the banks will possibly, some will allow you to exclude that portion of debt. So this is how you hear of these property investors that pop up and say, I have 10, 20, 40, 50 properties. No one can buy 50 properties in their individual name. It just does not happen. Most people will buy 1, 2, or 3, max out their borrowing capacity, be stuck for a number of years. So a bit of a method that some people are utilizing now is purchasing via a trust, holding the property in there, getting the accountant's letter to be able to exclude that property, and then rinse and repeating that strategy over and over again. So it's a bit of a way that you could possibly look to get your borrowing capacity up, but it is difficult to find a property that can cover its own mortgage repayments in 2025 when interest rates are 6%. So where I'm seeing it be pretty effective is things like Airbnbs and apartments. Although the yields and growth, may not be as good, it can sometimes give you the higher cash flow that you need to be able to achieve that, or putting a granny flat in your backyard, or doing a subdivision, or all those different methods to try and generate more income from that particular property to get it to break even. So definitely some ways that people are getting their borrowing capacity up and being able to exclude some of that debt.
Yeah, it sounds like there's some really clever strategies out there, and it sounds as well as that it's very individualized. So it's important if you want to do something like this to have a chat with someone to give you advice based on your personal situation to know what you can really do.
Yeah, exactly. Come have a chat, sit down with the accountant, have a chat with your broker. Just try and get as many people involved as you can, and get that team built around you to support you. Make sure you're getting that right advice piece. Because going back to the first thing that we started with, was one of the biggest hurdles and things that's stopping people from attaining funding is basically not planning. It's poor planning. It's not being in a position to proceed. It's basically trying to jump the gun, and that's often a bit of a hurdle for you. So plan it out, take your time, get the right advice, and then you'll be in a good position. And then you can look at different assets down the track, commercial property, buying in an SMSF, all different ways that you can try and buy more assets. Maybe when you do cap out how much you can get, by yourself, and look at different vessels to be able to borrow additional funds. So all different ways that we can help you.
Great. And one final question, Dan. If you could give one golden piece of advice to business owners and investors about financing, what would that be?
One piece of advice. All right, I'd say always structure your finance with the future in mind. That would be my one line to go to, mate. Always structure your finance with the future in mind, because if you just kind of jump in the gun, and I've done it myself and seen the shiny object syndrome, where you just go and find that beautiful purchase or a great opportunity right now, maybe you jump in a little bit too soon. It's costly to undo what you've done. So if you ever need to go back and restructure, or maybe, make some changes, often it can come back to bite you. So always structure your finance with the future in mind, plan it out, get that advice piece, and you'll be good to go.
I think that's great advice. Great advice for everyone. So, well, yeah, thanks very much for that, Dan. That was great. Really appreciate your time today. I'm sure everyone got a lot of interesting insights out of that, like I did. So yeah, thanks for your time, guys. I hope you appreciate Dan's time. If you've got any questions or you want to reach out to him, please drop a note in the comments and he'll be in touch.
Lovely. Thanks so much, and I hope you will have a good one. Bye.
You too, mate.